Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Community Healthcare Trust Incorporated Annual Report. Community Healthcare Trust Incorporated is a leading provider of healthcare-focused real estate investments. The company's portfolio consists of over 200 income-producing properties across 36 states in the United States. These properties total approximately 4.6 million square feet and are valued at around $1.2 billion. The company's primary focus is on owning and investing in real estate associated with outpatient healthcare services. This includes a range of businesses and services, such as medical office buildings, ambulatory surgery centers, imaging centers, and other specialized facilities that support the delivery of healthcare services outside of traditional hospital settings. Some examples of the types of properties included in Community Healthcare Trust Incorporated's portfolio are medical office buildings, ambulatory surgery centers, imaging centers, specialty clinics, rehabilitation centers. These investments provide a stable source of income for the company, and its diversified portfolio helps to mitigate risk. By focusing on outpatient healthcare services, Community Healthcare Trust Incorporated is well-positioned to capitalize on trends in the healthcare industry that prioritize community-based care and outpatient treatment options. The stock price of Community Healthcare Trust Inc. CHCT experienced a slight increase in the past year, rising by approximately 9.8% from January 2, 2026 to February 11, 2026. This upward movement can be attributed to several key events that took place during late 2025 and early 2026. One significant factor was the company's capital recycling real estate transactions in December 2025. By selling an inpatient rehabilitation facility for $29.7 million and acquiring a new one through a 1031 exchange, Community Healthcare Trust was able to reinvest sale proceeds at a premium and reduce its largest tenant concentration. This strategic move likely boosted investor confidence. Additionally, the company's board of directors approved an amendment to its employee and director compensation program in January 2026, adding 500,000 additional restricted shares of common stock to the program pool. This move demonstrates the company's commitment to rewarding its employees and directors, which can have a positive impact on morale and productivity. Furthermore, Truist Financial upgraded its price target on Community Healthcare Trust from $19 to $20 in January 2026, reiterating a buy rating for the company. This analyst rating upgrade was part of Truist's broader 2026 outlook for the REIT sector, highlighting improving fundamentals. Finally, Community Healthcare Trust announced an increase in its common stock cash dividend for the quarter ended December 31, 2025, to $0.04775 per share, payable on March 4, 2026. This consistent history of increasing dividends every quarter since its initial public offering demonstrates the company's commitment to returning value to shareholders. These events collectively contributed to the slight increase in Community Healthcare Trust Inc.'s stock price over the past year, providing a positive outlook for investors. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be inferred from various key points extracted from its annual report or financial statements. Revenue growth is attributed to several segments, including acquisitions of new real estate properties and lease expirations and renewals. The company's geographic concentrations in specific states such as Texas, Illinois, Florida, and Ohio also contribute significantly to revenue. The type of properties invested in by the company plays a crucial role in its financial performance. Medical office buildings, inpatient rehabilitation hospitals, and specialty centers are among the various property types that have been invested in. The company's financial performance is influenced by factors such as net income, loss, operating activities, gross investments in real estate properties, number of properties owned/leased, and occupancy percentage. However, the company may be exposed to risks related to lease terminations and renewals, changes in market lease rates, and credit loss experience with borrowers. A more detailed analysis of the company's annual report or financial statements is necessary to gain a deeper understanding of these factors and their impact on revenue growth or decline. Net income and profit margins. A tale of 2 years, the net income of the company underwent a dramatic shift between 2023 and 2025. In 2023, the net income stood at $7,714,000, but it plummeted to -$3,181,000 in 2024 due to various factors such as exposure to contingent rent escalators, weak economic conditions, and underperforming development projects. However, the company managed to turn things around in 2025, with net income increasing to $5,102,000. A similar trend was observed in profit margins. In 2023, the profit margin stood at a respectable 12.1%, but it took a nosedive to -6.2% in 2024 due to the same reasons that affected net income. However, the company's fortunes changed once again in 2025, with profit margins increasing to 5.2%. The significant improvement in profitability from 2024 to 2025 was the primary reason for this increase. The fluctuations in net income and profit margins can be attributed to a combination of external factors, such as economic conditions, and internal factors, such as development project performance. Despite these challenges, the company demonstrated its resilience by adapting to changing circumstances and implementing strategies that led to improved profitability in 2025. The company's financial performance has been a subject of interest in recent times. A closer look at the data reveals a promising trend. According to the information provided on page 79, the company has consistently generated positive operating cash flow over the past 3 years, 2023, 2024, and 2025. This is a significant indicator of the company's financial health. The fact that the company has been able to generate positive operating cash flow for 3 consecutive years suggests that it has a stable business model. The ability to generate cash from operations indicates that the company is capable of meeting its financial obligations and investing in growth initiatives. This trend bodes well for the company's future prospects, suggesting that it is on a solid footing financially. The company's debt level has experienced significant fluctuations over the past few years. According to the extracted summaries, the debt level increased by $46.2 million from 2024 to 2025, and by $116 million in another instance. This indicates a notable rise in the company's debt obligations. Regarding interest expenses, there are mixed signals. On one hand, interest expense decreased by $1.8 million, 112.8%, due to reduced interest on notes and amortizing payments. However, in other instances, interest expenses increased significantly, with an increase of 13.8%, $3.3 million, from 2024 to 2025, and a change of plus 53.6% from 2023 to 2025. The inconsistencies in the data suggest that changes in interest rates have had a significant impact on the company's interest expenses. The fixed interest rates on a portion of the debt and the floating rate for the remaining amount may also be contributing factors to these fluctuations. Overall, it appears that both the company's debt level and interest expenses have undergone notable changes over the past few years. The management of the company is optimistic about its outlook and strategy. The company has a pipeline of 5 properties under definitive purchase agreements, which are expected to generate returns ranging from 9.1% to 9.75%. This indicates that the company is focused on acquiring and owning or financing healthcare-related real estate properties throughout the U.S. to fund these investments. The company plans to use various means such as cash from operations, equity or debt issuances, credit facility, and asset sales. The management also emphasizes the importance of maintaining its REIT qualification by distributing at least 90% per annum of its taxable income to stockholders. The company's geographic concentrations are primarily located in Texas, Illinois, Florida, and Ohio, with a diverse tenant base that has no customers accounting for more than 10% of its consolidated total revenues. The real estate portfolio is expected to generate significant future minimum lease payments, indicating a stable source of revenue. Overall, the management strategy appears to be centered around acquiring and owning or financing healthcare-related real estate properties while maintaining compliance with financial covenants and REIT qualification requirements. This suggests that the company is committed to long-term growth and stability. The company has made several strategic acquisitions and divestitures as part of its business operations. In terms of acquisitions, the company has purchased various healthcare properties at fair prices, acquired assets under long-term net leases with fixed-rate rental escalations or CPI-based escalators, and invested in properties with some level of vacancy at time of closing. Additionally, the company has acquired certain assets or interests in certain assets subject to existing liabilities and properties or portfolios of properties through tax-deferred contribution transactions. The divestitures made by the company include selling one property classified as held for sale with a net investment totaling approximately $5.3 million. The company has also discontinued services at healthcare facilities, which could be considered a form of divestiture. Furthermore, the company has sold healthcare properties at a loss in uncertain market conditions and forced sales of healthcare properties at inopportune times, resulting in substantial losses. In some cases, the company has provided financing to purchasers, which may result in delayed distributions and potential defaults. The company has a history of paying dividends to its shareholders. This is evident from various references throughout the document, which consistently state that the company has paid dividends. The amount of dividends paid has increased over time, with $48.1 million in 2023 and $51.7 million in 2024. In addition to the annual payments, the company also made dividend payments in 2025, totaling $53,669. The company's commitment to paying dividends is further emphasized by its quarterly common stock dividend declarations. For example, a quarterly common stock dividend was declared on February 12, 2026. This demonstrates that the company has a regular and ongoing practice of distributing dividends to its shareholders. In summary, the company has paid dividends in various years, with increasing amounts, and has also made quarterly dividend payments. Supply chain disruptions pose concerns, not inventory buildup. The current market landscape is fraught with challenges that could impact business operations. One area of concern is supply chain disruptions, which have increased costs due to factors beyond control. This includes higher expenses for materials, parts, and labor. Furthermore, market volatility and disruption may hinder the ability to secure new debt financing or refinance existing debt on favorable terms. Additionally, reliance on vendors for information technology poses another potential risk of supply chain disruption. These concerns highlight the need for companies to be vigilant in managing their supply chains and mitigating risks. However, it is reassuring that there are no concerns about inventory buildup mentioned throughout the report. This suggests that businesses have been able to manage their inventory levels effectively, avoiding a common pitfall that can lead to further complications. That concludes the financial summary for Community Healthcare Trust Incorporated. Feel free to comment below, and I will be happy to answer them when possible.